Welcome to Let's Talk Global Business, the show in which we look at the economic and business trends connecting the world. I'm Sarah Murray, Managing Director International at the Conference Board, the member-led global think tank that delivers trusted insights for what's ahead. Today, we're focusing on how businesses can manage geopolitical risk, with a particular focus on economic relations between China and Europe. China's economic achievements in recent decades have been extraordinary, but we're entering a more uncertain era. Even prior to the COVID-19 pandemic, tensions were rising between the US and China over trade imbalances and control of the South China Seas. Since then, China's problems appear to be mounting. Falling property prices, increased debt, and Western hostility have led some observers to claim that the era of China's economic miracle is over, and a new age characterized by low growth, an aggressive foreign policy, and domestic repression has begun. If this is indeed the emerging picture, European businesses are caught between a rock and a hard place. Many have spent decades investing in China. A recent survey from the Conference Board revealed that just 2% of European businesses are prepared to leave China, even as they cite geopolitical upheaval as one of the biggest threats to their business in 2024. Today, I'm joined from Stockholm by Frederic Cho, founder of Frederic Cho Advisory and vice chairman of the Sweden-China Trade Council. Frederic has worked with China since 1980 and studied and worked in China for over 18 years in finance, life science and media, and acted as a trade advisor to the Swedish government. From Beijing, I'm joined by Alfredo Montufar-Helu, leader of the Conference Board's China Centre for Economic and Business. Frederic, Alfredo, welcome to Let's Talk Global Business.
Thank you.
Thank you, Sarah. Pleasure to join.
So, Alfredo and Frederic, let me begin by asking you both, from where you're sitting in Beijing and Stockholm respectively, was that picture that I painted of the emerging environment in China fair, and what are the implications for European businesses?
Yeah, no, it's fair and accurate. China's constantly evolving marketplace requires foreign companies to always be on the alert and in tune with the developments in China or external developments affecting China. China sees EU's policies towards China as a traffic light: green, yellow, and red, given EU's tripartite approach, red being a systemic rival, yellow being an economic competitor, and green a partner for cooperation.
Alfredo?
Thank you, Sarah. Well, first, let me talk about the economy and tackle the elephant in the room. Looking at media headlines, people must be wondering if China is leading to an economic hard landing, that the economy is going to crash. And we think not. Now, growth is certainly slowing down, and this slowdown has accelerated over the past few years. But the Chinese economy is not shrinking. The size is actually over 27% larger compared to pre-COVID levels. What is happening is that Chinese economy is on a down cycle that has been triggered by the impact of zero COVID restrictions and the property downturn, and which is underpinned by deep-rooted structural imbalances. While the down cycle that China is experiencing is not a surefire indication that the economy is leading to a hard landing, it is, however, a surefire signal that the structural imbalances have reached a critical level and are now threatening its transition to a more sustainable consumption-led growth model. Of course, with respect to the tensions that you were mentioning, of course, that has increased over the past years dramatically. And I think that in many ways reflects concerns from Western governments with respect to what China's rise means for the international global order. The US has been very clear in its national security strategy, which it released in October of 2022, that they see China as the only country with the capabilities and the intention to change the global order, and they're not going to allow this to happen. Now, with respect to Europe, of course, Europe has very big concerns about what China's manufacturing overcapacity implies in terms of exporting this excess capacity to the European market and leading to a hollowing out of industries in strategic areas such as new energy vehicles, but also in other areas. So risks are increasing. But despite these risks, as you very well mentioned, our survey shows that multinationals in China do not want to leave the market. And every time I talk with CEOs that are leading companies here, that's a message that they give me, that despite the challenges, they are committed to the Chinese market. They are, however, rethinking their supply chains. And we can talk a little bit more about that later today.
Thank you, Alfredo. Thank you, Frederic. So, if I just take the traffic light system, Frederic, that you mentioned earlier, maybe there are two traffic light systems at play here. There's one on the kind of geopolitical level, between how the governments look at one another, and then there's also kind of on the business level how businesses or foreign multinationals are color coding the risk that they see. Would you say that that is fair?
Yes, I would. I mean, you have politics on one side, then you have business on the other side, and closely linked to the political side, I would say you have media, which is actually influenced by, I would say, I mean, very much the Anglo-American or the American narrative on China, which I don't think is totally in harmony with what Europe naturally would look at China. It's not only Germany that has another view on China that the Americans have. Sweden, the Nordics, the same.
Hmm.
But that is complicating things, especially for listed companies, where they might be sort of caught in the crossfire between what they think makes sense business wise and what they feel they need to say in both directions, both towards the media in the West and towards the Chinese market. So it
Hmm.
navigating the sort of this archipelago of challenges is getting more and more challenging.
Let's dive a bit deeper on Europe-China relations and operating in China. Do you believe that there's still scope for cooperation between European and Chinese businesses?
Yes, of course. I just had a meeting in Beijing last Friday with my old friend Matthias Lenz, who is number two at the EU embassy in China, and we confirmed that the green transition subject is one of the subjects of least resistance for discussions, meaningful discussions between EU and China. But of course, is a challenge is that China has a massive trade surplus on EU, and that needs to be balanced. But China, of course, has a big trade surplus on the US. The Americans are talking more about decoupling, meaning decoupling. EU means de-risking, saying that, well, we want to continue to do trade with China, but on a more equal and fair basis.
Alfredo, would you concur? And how central is this shared concern with sustainability and the environment to the future partnership between Europe and China that you're hearing amongst the China CEOs of foreign multinationals that are at your China center?
Well, I concur, of course. This is one of, if not the key topic, where both sides can make meaningful progress in terms of cooperation and collaboration. And that's not surprising given how decarbonization by itself is one of the key goals for the Chinese government. I see more and more multinationals doing good things in terms of energy transition, either by sharing technologies or investing in energy transition areas here in China, and they are making profits out of it. So definitely area of collaboration.
How are those tensions affecting the scope for partnerships on tackling climate change, or you're not seeing anything just yet?
No, that's a great question because it's the paradox, right? Because while at the same time we have the fact that green transition is one of the key areas of collaboration, but then NEVs, the production of NEVs and exporting of NEVs from China to Europe, that causing tension. And so how can that be? Well, the fact is that China right now is investing a lot of money in the manufacturing sector as a way to offset the reduction of investment in the property sector, which he really has dropped because of the downturn. And this added investment in manufacturing is leading to a lot of production of NEVs. So it's actually causing excess capacity. The problem then is that this excess capacity is being exported to Europe at very competitive prices.
Frederic, you mentioned earlier that The EU have chosen the phrase de-risking. They want a more equal partnership. But just from this example, as China's increase in exports to the EU is happening, but they're also increasing the production of goods that they would normally import from Europe, it's very difficult to see how Europe can get to that equal partnership.
It is. It's true, and that's why the tensions will rise, continue to rise, also between EU and China. I followed China's entry process into what was originally GATT, which later became WTO. I mean, it took China 15 years to join from 1986 to 2001. But at that time, China actually conceded on many areas because it was China against the world. Now, if the world sort of coalition could be reestablished in making China understand that it's for their own best benefit that they open up their domestic market, then I think the risk of having a massive trade surplus, creating trade tensions, creating trade war, could be avoided. But we need to cooperate. I mean, the U.S., North America, EU, and others, to make sure that that China starts complying or abiding with our wishes, because otherwise, I can't really see this ending in a happy way.
Well, just if I may add something to that, Sarah, the issue about market access reciprocity is not only about opening up. Of course, there are some restrictions that China has in several sectors, either by law because they have a list or a negative list of foreign investment, or because there are just cumbersome administrative procedures. So there's not only that, right? When the companies come to China and try to compete, well, they cannot compete.
Mm,
Not because they are not able to compete, but because their prices are too expensive for the Chinese market, and the alternatives here in China have better prices. So it's very hard then for companies in Europe to be able to compete against that. But the market hasn't closed, right?
mm,
And it's more about, I think we are going into a conversation of like, China, we want you to control your own production because we want to be able to sell you our own products. And so that's when it gets a little bit difficult, right? Because obviously China is going to say, well, I mean, why would I control my production? I mean, my companies are producing,
mm,
they are able to sell to the people who buy those products because they're more competitive.
mm,
That's the argument, right? And of course, from Europe, it doesn't seem like it, but
mm.
that's where we are.
Yeah.
What do MNCs need to do here?
Well, I mean, MNCs are active 24/7, 365, and finding sort of flexible ways of staying in the market as long as they think it's commercially justified. I mean, the conference board's own survey showed that 2% of the European companies is maybe inclined to leave the country, but 98% will remain in the market. So they will be as flexible as they are. I mean, coming to the competitiveness question, well, I've thought about this for decades, but I think there's only one solution, and it's both simple and difficult at the same time. I mean, European companies have to be always stay one step ahead of the Chinese competition, which is easier said than done. But that's the only way to survive. And of course, we need to do certain things maybe on a sort of pan EU European market level. We should, for instance, maybe have a unified 5G market. We don't have that. What is it? 120 telecom operators in EU. China has three. The US have five or something. Sweden is not in the forefront of the 5G development. Switzerland has 100% coverage. I mean, this is just one sector, but there are many other sectors that we need to be. If we want to be best, we have to make sure that we are the best.
Alfredo?
I think it's very hard to think about an alternative to China in terms of supply chains. The role it plays in international supply chains, it won't be easily replaced by any country. We're talking about a modern industrial ecosystem that is strongly connected to the global economy thanks to its massive high quality transportation infrastructure. It generates synergies and it actually brings costs down. China also has a very highly educated workforce. And so it's not an easy decision to shift supply chains away of China. Agencies are thinking about two main things. First of all, how can I localize as much as possible the supply chains that service the Chinese market and which can also be leveraged to service global demand? And secondly, how to diversify the supply chains that service global demand to other manufacturing hubs. And what that does is to ensure continued access to China's market potential while also it strengthens the resilience of global operations.
Thanks, Alfredo. So, I mean, you've just picked up on a really interesting point about localizing operations. And we've seen in the conversations that we have with China CEOs that the role of local partners is changed in recent years. Can you talk a little bit about that, Alfredo, and Frederic chime in?
Well, Sarah, I've always liked to say that if you want to understand how to play, who to play with, and where to play with, local partners are essential.
Yeah.
And so that's something that has been true over the past years. And it's more important than ever because a local partner can help you actually de risk China. Not only that, I mean, if I look at how the market is changing, because the market is changing here in China, how to compete is changing here. It's not the same as before. And I'm hearing more and more that whereas multinationals used to grow in China just by the sake of being here because China was growing so fast, now they actually need to compete to gain the market share, perhaps from competitors, many of them being Chinese companies. What we are seeing, the softening of demand, the consumption downgrading, actually is pushing competition to lower price points. And so at lower price points, Chinese alternatives are just more competitive. And so they need to learn how to compete against that. Having a local partner then is very useful.
I totally agree. I mean, I worked in the first Swedish-Chinese joint venture in Wuxi with Astra, the life science pharmaceutical company, in 86 to 87. There were local partners. There have always been local partners, regardless if you're a minority joint venture, majority joint venture, wholly owned foreign invested company, or made acquisitions. You need good local partners to provide you with this kind of intelligence that you cannot acquire yourself. So they are totally indispensable, not only on the commercial side, but now more and more also on the innovation side. You hear from the MNCs you talk to is that we're in China not because it's cheap, but because it's innovative. We need to learn to be as innovative as Chinese companies are. Then we can use this on a global scale. And it used to be the other way around. Now Chinese companies are coming to Europe with innovation. So where would you be without good local partners? So you need them as a filter, as a partner, as sort of an extension of corporate ambitions.
Just to kind of summarize what I think we're just touching on, Europe is China's largest trading partner. Obviously, there's a challenge because China's massive trade surplus with the EU needs to be addressed. It's not practical to decouple. And at the same time, even though it's more difficult operating in China, actually Europe need to learn from China to improve their competitiveness. You know, they have an issue with that. They need to think about if they want to be the best, how do they do that? And some of those learnings actually could come from being in China because they're going to learn about innovation. They're going to learn about how to stay competitive in an increasingly difficult market. So quite a needed relationship, even though it's a tense one.
Indeed, but let me add to that. An innovation in Europe is about over engineering. Make the thing better, but it will get more complicated. It will get costlier. In China, it's about finding solutions that are more efficient in terms of reducing the costs. And I heard already this from several companies is that there are products that they create here, that they innovate here, and that sell very well in emerging markets because they are less costly and they're faster to produce. Not only that, but I've heard also from two companies actually. When they came to China, their products actually were too pricey for the market. So they had to think about how to make them fit the market in a more efficient way. And so those products actually, they found a way to reduce certain costs by eliminating some of the over engineering, and then they were able to compete in China, and then they were able to compete in other markets, right? So they were able to outcompete the Chinese competition and then they were able to outcompete Chinese companies in other emerging markets. When you think about why being in China is important for European multinationals, is not only because of the Chinese market in
Yeah.
itself, but it's because if you think about the next 3 to 4 decades of growth, actually the delta of growth will not be in China, it will be in other emerging markets. In those markets, Chinese companies are going to be very competitive. And so European companies, American companies, if they want to be able to maintain their market share there, to compete with the Chinese companies, they need to be here to build those efficiencies and to learn what the competition is doing.
Really interesting, Alfredo. We're going to take a short break, and when we come back, we'll continue this discussion on relations about Europe and China, and we'll be looking also at the role of the US and how businesses can navigate those changes.
Are you ready for the future of business? This year we are launching our international conference series. Curious about emerging trends for rewards globally? Join us June 20th to 21st in Brussels for Future Reward Europe. And finally, tap into the power of ecosystems at Future, Innovate and Transform, November 13th in Amsterdam. You can find details on the programme at conference-board.org/conferences. Join us to get inspired, gain actionable solutions, and connect with global peers.
Hello and welcome back to this conversation with Alfredo Montufar-Helu and Frederic Cho. We're talking about how changing relations between Europe and China is impacting business. I actually want to shift gears a little bit though, and I want to, talk a little bit about the role being played by the US. Alfredo, you contributed to an article last week in the Wall Street Journal describing the role of the House Select Committee on the Chinese Communist Party, in which you talked about geopolitical crossfire. So how do you think US policy is shaping European business decisions?
Well, European multinationals are also operating in the US market, and the US market is one of the most important markets for them. The decisions that the US makes in terms of policy, the reality is that they impact multinationals wherever they are. So, of course, um, this is increasing the risk of European MNCs to get caught in the crossfire, right? It's just increasing the risk of reputational damage, right? One of the things that happens with the committee is that it's public, and if you have seen some of the videos and some of the testimonials that these companies make, it's just very anti-China, right? And so the politicians just really have a, I would say, aggressive way of portraying executives, right? So nobody wants to actually be called to testify to the committee. So it just means that executives take a very low profile, right? And unfortunately, what this means is that the traditional role, the traditional bridging role that multinationals used to play between China and the West has it's not there anymore. So this echo chamber is really hurting, and more importantly, or more worrisome, is that it's leading to misalignment
Yeah.
between global headquarters and the China operations.
Yeah.
Interesting. Frederic, is that, do you share that experience or that
Yeah.
observation?
Oh, yes. And I think it's very difficult to predict, like predicting the weather in Scotland. I mean, what is the stance of the US today or in 15 minutes? And by the way, Mike Gallagher, as I understand, he will be leaving his position at the House Select Committee soon. So who will replace him? Will that also be another sort of ultra hawkish kind of person or not? I think it's good to have the US role as a reference, but definitely it's not the law or standard. I mean, Mexico, Sweden, other countries, we can think for ourselves. There are areas where, of course, we're in total agreement with the US, but there are other areas where, sorry, but the US have to accept that there will be differences in views of opinion. And who knows what will happen in November if Mr. Trump comes back. I think that we also need to be aware of the reasons why Sweden and China have had its own unique relationship, and Mexico and China as well. Sweden was the first non-socialist country to diplomatically recognize the People's Republic of China in May 1950. The US did that in 1979. Swedish companies had dealt with the Chinese market since 1894 in the case of Ericsson. So they've been in the Chinese market for 130 years. So it's, as I said, it's good to have the US role as a reference, but it's definitely not the standard that we all have to comply with.
Thank you. I now want to take a turn to talk a little bit about how businesses can manage some of the issues that we've been discussing. And let's just think about managing conflicting social values. So, Alfredo, there's been allegations in the US about entertainment companies self-censoring to protect their market position in China. You mentioned MNCs are becoming much more careful in how vocal they are. How can global businesses managing these conflicting social values and responsibilities?
That's a very good question, Sarah. When tensions rise, you suddenly realize as a multinational that in every geography that you are, you have very different stakeholders with very different views, very different values, very different cultures. When you are in that situation and suddenly there is a conflict, for example, then you have to be very careful because whatever you say with the power of social media, everyone will hear. And you don't know how people will react to that. We saw some of that, for example, during the unfortunate conflict between Israel and Hamas. There were companies that in Israel they took a position, and the same company, the same subsidiary, but on the other side took another position. And then the global headquarters said something about who should take which position, and it just became a mess, right? Social media started just producing these posts with people criticizing these MNCs because of what they said or what they did. You're suddenly a target, right, for these voices that may have a hidden agenda, may not have a hidden agenda, but it doesn't really matter because your reputation is already damaged. And so crisis control under those conditions is really, really hard. So what I'm trying to say with this is that it's not about self-censoring, is the fact that under the current conditions of geopolitical tensions rising, where public sentiment volatility has increased, where there is a vicious circle of disinformation and miscommunication, multinationals obviously have incentives to keep a low profile.
How would you say managing geopolitical risk then differs from managing other reputational risk? Because this is not going away, and multinationals really need to think carefully about how they plan ahead, the potential risks while they continue to operate in China. What can they do to protect themselves from geopolitical risk?
A lot of them are doing a scenario planning, are planning how to, or are preempting. They are trying to do contingency planning rather than only crisis management. So they are trying to prepare themselves for this, what we call here at the conference board, gray swan geopolitical risks. And part of our job at the China Center has been helping them with regards to this. For example, we built a list of risks that we think may happen, and then if they happen, what would it mean in terms of the reaction of the governments, of the reaction of the clients, or the reaction of the market itself? And under those circumstances, what can companies do? So I've been talking a lot about that with our members. I've been also talking about that with some of the people we collaborate here, trying to find some trigger points in order to try to assess the likelihood of such event happening. But to be fair, Sarah, it's a very difficult situation, right? One can only plan for so much. And as we know, there are certain things that when they happen, it's just impossible to know what to do.
I totally agree with Alfred. These conversations I have with the large cap companies, boards, executive management on a very regular basis. I mean, there's scenario planning. I mean, I'm stating the obvious, but you always have to prepare for the unexpected, to have plans and strategies how to deal with them when or if they happen, and how and if that happen, how do you communicate that to market? How do you communicate with the consumers and customers? So just think, I mean, doing this continuously, I think is good to staying alert. You never know what will happen tomorrow or in the next minute or so, but at least you know that there are different scenarios that could happen. So you're a bit more mentally prepared.
Multinationals know how to respond to negative market conditions. Of course, they love positive market conditions, but if there are negative market conditions, such as a down cycle, they know how to respond to it because they can predict and therefore they can plan the actions to take. The problem with uncertainty, with geopolitically driven uncertainty, is that there is no predictability. So, how can they plan? Therefore, there is paralysis. The way they respond to that is, of course, trying to think about potential scenarios
Yeah.
and then what they would do in each of them.
It's clear that tensions have increased dramatically. They're not going to go away. Yes, they need to be managed. Companies are operating in an incredibly uncertain environment, and it seems to be getting worse and worse every year. So, scenario planning, contingency planning, thinking about disciplined communication, do this continuously because the environment is not changing for the positive anytime soon. This is the norm, and this is something that foreign multinationals really need to pay extra attention to for the benefit of their brand, for the benefit of their reputation. So, very, very, very difficult times. That, gentlemen, brings us to the end of this episode. We've covered so much ground. I want to thank you so much for your time and for your fantastic insights. We'll be back next time with a focus on a very different topic, the new frontiers of wellness, with contributions from the US and Europe. You can find Alfredo's recent report on managing geopolitical risk on our website, as well as listen to our entire catalogue of podcast programming from the conference board by visiting our website, conference-board.org. Thank you, Frederic. Thank you, Alfredo. And see you all next time.
Thank you very much.
It's been a pleasure. Thank you, Sarah.